All right, hello, I am Nathan Garcia. Today is February 5th, 2018, and if you've been following the markets at all today, you might be a little shocked. You might have some questions about what has taken place and how that impacts your portfolio. A lot of people are looking at these markets and they've seen them go up and up and up. They've seen the record highs that we had last year, and now they're looking at it and saying, has the bull trend ended? Right? Are we going to pivot now and the market's going to drop? And when you look at the performance that we saw in the market take place last week, and then what we're seeing today, some of that concern might be warranted. So today, what we saw was that the Dow ended up down about 4.6%, down 1,175 points. At its worst point, it was down 1,500. So it was down 1,500 points at the worst point of the day. That was around 3 o'clock. NASDAQ was down 273 points, and then you had the S&P 500 down about 113 points. The market was really treading water coming into the morning. Remember, last week we had a pretty big sell-off. I mean, it was relatively big, right? We haven't seen a great pullback in the market. And so last week we saw about a 4% drawdown in the market. And that was interesting coming into this week because some of this may be a carryover. That's what I think, is that you have a little bit of a spillover from what happened last week, and now you have some funds adjusting. So what I want to do today, share with you what's occurred, share with you why that may be occurring, and then help answer where you should go for some resources to improve your investment situation. As always, this advice is not related to you and your financial situation. I don't know about your situation, and so I'm not going to give you financial advice here over this video. I recommend that you speak with a CFP, a registered investment advisor, and a licensed financial advisor before making any decisions about your portfolio. With that being said, let's look at the financial performance of the stock markets today. This is a website called finviz.com, finviz.com. It's a great free resource to help you out. Across the board, when we look at the markets, you see that it's just a bloodbath, right? It's all red. What I think is very interesting is when you look at the FANG stocks, Facebook, Amazon, Netflix, Google, you see all of those down, right? You see Apple down. And so that's very interesting because that's been a play for a lot of people. A lot of funds have been piling into these. You see that the market was down about 4%, and you see these are down similar amounts. What I think is more interesting, though, is the U.S. 10-year and the U.S. 30-year bonds. Last week, we saw that the 10-year got up to about 2.8%. You see that here. And then you also had the U.S. 30-year get above about 3%. And so what was interesting is that you have that taking place. Remember, we just passed this major tax legislation that tells the market that we are going to need to produce more bonds, sell more bonds in order to fund our deficit, right? We know that the amount of revenue that we have coming into the government will not be enough to cover all the expenses that we have. And so the way that the government pays for that is by issuing bonds. Well, the U.S. government is going to be issuing more bonds to cover this deficit, and that's occurring at a time where interest rates have increased, right? We've heard from the Federal Reserve, well, we saw last year the Federal Reserve raise interest rates. They've told us that they want to raise interest rates another 3 times this year. And so as a bondholder, that may not be attractive for you. You may be saying, well, why would I want to hold on to those bonds or existing bonds when higher paying bonds will be coming out here soon? And so you may have seen a sell-off related to that. And it's important to remember that as interest rates increase on your bonds, the actual value decreases. So there's an inverse relationship between interest rates and the value of issued bonds. And so as interest rates increase, the value of a bond that's already been issued decreases. Okay, and so it becomes less attractive. The easiest way to think of this is, why would I want to hold a bond at 3% if I know that next month the interest rates may be 3.25%? Well, maybe I'll just wait until next month and I'll get the 3.25% one. Okay, so it's interesting to look at the the bond market itself and look at where interest rates are. Now, why would this cause a sell-off in the equity market, in the stock markets? Well, you could see funds like what you call a managed future fund. A managed future fund, it may be known as a CTA, a commodity trading advisor. You might have a fund that is willing to go long one asset, they're willing to buy one asset at the same time that they sell another asset, right? So if you think back to like the volcano in Iceland back like 6 years ago, you saw that Heathrow, the international airport, they grounded all of their jets. They said nobody's flying over the Atlantic into the U.S., going right over the volcano. And so some portfolio managers looked at that as an opportunity and they said, hey, I'm going to sell jet fuel because jet fuel is not going to be as in demand with all these planes sitting here. But those goods still need to get across the ocean, and so I'm going to go long diesel fuel. Okay? Diesel fuel is what powers cargo ships. And so there you have a situation where they sold off jet fuel because they thought it was going down, and they bought diesel fuel because they thought it was going up. You may see a situation where you see bonds start to sell off, and some of these funds have to reposition their portfolios for the right amount of risk. The other one would be like a risk parity fund, where you may see a risk parity fund only goes long, right? They only are buying certain asset classes. They're not selling at the same time. And so that might be influencing this to some degree. What's interesting that we haven't really seen play out before is that you have the high speed trading, the high frequency trading that really amplifies some of these sell-offs. Because a lot of these funds have an underlying algorithm that helps dictate what they should buy and sell, or the amount of risk that they should have the portfolio tuned to, you may see a situation where this feeds on itself. And so you might have a sell-off that is minor, but it grows into a bigger sell-off because the machines kind of overdo it. And so I wouldn't be surprised if you see some sort of bounce back here tomorrow, but I'm not predicting that. I'm just saying I wouldn't be necessarily surprised, as you may find out that the algorithms really had maybe overdone it leading into the end of the day. And the reason that I think that could be possible is you look at the pickup that occurred right between 3 and 4 o'clock there, and you notice that there was still a sell-off. So I don't know, it'll be interesting to watch this going forward. What should you do about it? If you're looking at your portfolio and you're getting nervous and you're saying, I need all this money to retire, first off, you have to look at it and say, you know, the market has gone up for 9 years, essentially, right? From 2009 until 2018, we've really just had a great performing market, largely thanks to the central banks and all the quantitative easing that they've done. But at this phase, it's healthy that we have a pullback, because that signals that people are re-evaluating the risk in their portfolio and they're positioning themselves for better future opportunities. Remember that the tax bill just went through late last month, and so we really haven't begun to see the impacts of that, and those impacts may be significant. The other aspect would be when we look at the timing of the year, right? We're in February, we just wrapped up January. Historically, your better performing quarters tend to be the fourth quarter and the first quarter. You have all of the retail purchases, people celebrating holidays, going out and buying stuff at the end of the year, and then in the beginning of the year you have businesses going out and making plans for the upcoming year, and they're buying things. And so with those two tailwinds, in addition to the tax policy, you might see the market continue to go up. I really don't know, I don't think anybody really knows. But at the same time, that might be a reason for you to continue to hold some equities. If you're getting nervous about where the market is and what it's doing, then that probably tells you that you are uncomfortable with your current portfolio. And so I would challenge you to say, what is the amount of risk in your portfolio? Is that amount sufficient to meet your retirement needs? And could it be decreased, and could you still meet your retirement needs? And so what I would look at first off is what your maximum drawdown is on your portfolio. today we have such great technology and tools where we can look at your existing portfolio and say, in a period like what we're going through now, what is the maximum drawdown? What amount of risk do you have on the table, and how do we reduce that? The other one would be, how much risk do you need to meet your retirement goals? If you know that you're going to live to age 95 and you need, let's say, $105,000 a year from your portfolio until that time frame, well, we can back into how much risk you need in your portfolio using a tool we call Monte Carlo analysis. Okay, so that could help you out. And then the other one would be looking at your asset allocation. If you're using a traditional 60-40 based model, you probably have room to improve that allocation model. And so you may find that it could be constructive for you to integrate other assets in your portfolio. So maybe you use assets like a managed future fund. I'm not saying that this is right for you. I'm just saying that that might be something that you look at and say, well, maybe I get some diversification from that. Or maybe you look at some hard assets like a commodity fund. Again, I'm not saying that's right. I'm just saying look at it. But it might be time that you start integrating some of these alternative assets into your portfolio in a way that can help reduce your investment risk, but help you get to where you're going for retirement. So I hope that this is helpful. If you did find it helpful, make sure that you give me a thumbs up, write a comment. If you have questions about your situation, what I'll do is I'll put together a third-party analysis for you with my team. We'll have our investment team look over your existing portfolio, and what we'll do is we'll analyze your portfolio to tell you exactly where your risk lies and how much that risk means to you and your retirement plan. And we'll do that for free as long as you mention this video. So thanks for tuning in, and I look forward to speaking with you soon. Take care.